guiding rules that you have to read and know for you to be comfortable with those topics. Yes. So this evening we'll be talking about variance. Variance is a very wide topic. So um, but I will give the major hints we need to know about this topic and give various formulas. Then I have quite a number of questions I want us to solve because there is a question I will forward on variance in the past question, May 2019. Yes, it's been long they tested a question in that form. So I'm disturbed to send that question. Let's attempt so that in case you are seeing a question in that form, we'll be fine. So variance, and also to talk about variance, for you to understand variance, you must know the basic variance first. You can't jump from the basic to the advanced. You must know what basic variance is all about. That is very important. That is very important. Okay, I was trying to see if I can put off our camera. So that is very important. Can you all hear me?
Yes, sir.
Yes,
Yes, I
Yes,
can
sir.
hear
Yes,
you.
we can hear you.
Yes, we can hear you.
Very loud. Very loud and clear.
No, somebody said he or she is struggling to hear me. So I need to quickly ask a question. Yes. Temilolua, are you set for us?
yes, sir.
Okay, but just a minute. Let me do something. You know, we Nigerians, we don't most times let me say most Nigerians, let me don't say we Nigerians, most Nigerians, they don't know how to follow decorum. See, somebody is disturbing us in this class. Let me remove her from the call. Let me remove her. As in, it's a simple thing. You can just mute yourself. But turn on their videos. Okay, I've off it so nobody can share the videos again. Yes. So let me have my the co-hosts Adibola Fabi, a co-host. Cletus, a co-host. Madam Dolapo, the majority speaker. That is she Fortune is Fortune. Fortune. When you follow her, that is my daughter's name. You're already a co-host. That is fine. Yes. All right. So Temilolua, can you just raise your hand up so that I can make you a co-host?
Yes, sir. Yeah.
Okay. Ibuke. Okay. How do Deborah, a co-host already?
Yes, sir.
Yes. Temiloluwa, are you Ibuke?
How do Deborah?
Yeah, how do Deborah? Okay.
Yes.
Okay. Raliat. Okay.
I am Igboke, sir.
All right, it's fine. I've seen it. So Raliat Musa, a co-host, and the third person. Why this presentation is to share ideas. Yes. Elizabeth is just to share ideas. From what they will be saying, you will learn something. Yes. I have my presentations already, so don't be scared. Maybe I have my presentations on every aspect of variance. So it's just to for everybody to learn. Me too, I want to learn from them. Elizabeth, can you just raise up your hand so I can identify you? Rally out, you're fine. You're a co-host. Elizabeth, okay, fine. All right. So Temiloluwa, you have the floor now. You tell us the aspect of variance you want to discuss, just in a space of 5 minutes.
Okay, sir. Good evening, everyone. Um, um, I really want to appreciate this privilege given to me to speak. I'm actually doing this for the first time, and I do not take it for granted. Thank you very much, sir. Temi, Tokpe Ola, Mr. Tokpe Ola. Thank you very much for this privilege. Um, Very quickly, I would like to define variance analysis. I would like to define variance analysis as a method used to analyze and understand the difference between actual and planned behavior in business, finance, or other field. It also involves calculating variances, identifying causes, and taking corrective measures. Actually, I wanted to speak about the question actually, like the question sent that Agege and Son Bakery Limited. Like I want to explain how to arrive at the formulas and all of that, the calculative aspect. I don't know if it's fine by you, sir.
Okay, right on, no problem.
Okay, thank you very much, sir. So the question, um it was tested last diet, November 2024, question 3 to be precise, and it says Agege and Son Bakery Limited uses absorption costing. It uses absorption costing technique in its accounting system. So first and foremost, I'd like us to identify something from this question. When we say that a company is using absorption costing technique in their accounting system, it simply means that they have to use um, standard profits when calculating their sales volume variance. If it is marginal costing, it simply means that it's not going to be standard profit, it's going to be contribution, standard contribution. We need to take note of this, which simply means that absorption costing goes with standard profit, while marginal costing goes with standard contribution. So back to the question now. The company produces and sells 3 bakery products, namely four corner loaf, round corner loaf, and executive loaf, which are substitutes for each other. The following standard selling prices and cost data relate to the three products. All figures assumed to be correct. I want to believe that we all have the question. We are all looking at it.
I'll present it now. Don't worry.
All right, sir. So after the figures now, the next paragraph. Annual budgeted fixed production overhead was 4,320,000 naira. The company policy is that overhead will be absorbed on a machine hour basis. We need to take note of that. Overhead is absorbed on a machine hour basis. So the standard machine hour for each product and the monthly budgeted level of production and sales for each product are as follows. We have the figures there. We have the product, which is FRE. Then we have the standard machine hour per unit, which is 0.3 for F, 0.6 for R, and 0.8 for He. Then we have the monthly budgeted production and sales, which is 10,000, 13,000, and 9,000 respectively. So actual volume and selling prices for the three products in a particular month are as follows. The same product FRE, then we have the actual selling price per unit, which is 220 for F, 260 for R, and 320 for E. Then we have the actual production and selling units, which is 9,005 for F, 35 and 85 respectively. Please let us take note of this. I'm going back to the monthly budgeted production and sales now. Let us take note that it's on a monthly basis, and the calculation we are meant to do here is based on annual. Is based on annual, so we have to take note of that as well. So now to the requirements. We are required to calculate the sales price variance. First and foremost, we need to know the formula for sales price variance, which is the actual price minus the standard price multiplied by the actual quantity. Actual price minus the standard price multiplied by the actual quantity. From our question, we have the selling price from the standard side. If you look at the question very well, we have the selling price and we have the actual side as well. So from our question, the actual price is for F is 220, for R is 260, for E is 320. Then we less it from the budgeted. Now we have for F, the selling price is 200, 250, and 300 respectively. So what we do is actual minus standard, 220 minus 200 multiplied by the actual quantity. From the question, our actual quantity for F is 9,005. So we multiply it by 9,005. That's 220 minus 200 will give us 20. Multiply by 95, then we'll get 190. For that is favorable. Hello, am I communicating?
Yes.
Can I have the question, please?
Okay.
The question is on the WhatsApp platform.
They post it on the WhatsApp now.
Okay, so when we multiply this, our answer will be 190,000 naira. That's for F. Then for R, when we do same, the answer is 135,000 naira. And for E, the answer will be 170,000 naira. All are favorable. The reason is because the standard price given to us is 200, but we were able to sell it for 220. So it means that we actually, gain additional 20 naira. We were given standard price of 200, we sold it for 220. So it means we have additional 20 naira. So it's favorable. That is for F. Then for R, we were given the standard price of 250. and we were able to sell it for 260. It means we have additional 10 naira. So that is also favorable to us. Then for E, we were given the standard price of 300 and we were able to sell it for 320. So it means it's favorable. So everything is favorable. So we add the values and we get our answer, which is 495,000. That's for sales price variance. Now let's move to sales volume variance. Under sales volume variance, our formula is budgeted quantity minus actual quantity multiplied by standard profits. Budgeted quantity minus actual quantity multiplied by standard profits. Here we have our actual quantity is in the question. That's our 9,005, 13,500 and 8,500 respectively. Then here we need to calculate our standard profit. We also have the budgeted quantity is in the question. The budgeted quantity is in the question. We have that's the monthly budgeted and sales. That's our budgeted quantity. So we have the 10,000, 13,000 and 9,000 respectively. Okay, so now we need to calculate our standard profits. In order for us to calculate our standard profits, to get our standard profits, we'll use the standard price less all the costs. That's the direct material, direct labor, variable overhead, then overhead absorption. Since the company is using absorption costing techniques, so we'll be using overhead absorption. So from the question, we have our standard price, which is 200, 250 and 300 respectively. That's from the budgeted side. We have our standard price there. Then to get our direct material, from the question we have for F, we have 25 kg at 3 naira. So it means 25 kg times 3 naira. The answer is 75. For R, 30 kg times 3 naira. The answer is 90. And for E, 38 kg times 3 naira. The answer is 114. Then the labor parts. We go to the labor. We have for F, we have 1.2 hours at 10 naira. The answer is 12 naira. 12 naira per hour. Then for R, we have 1.5 hours at 5 naira per hour. The answer is 15 naira. While for E, we have 1.8 multiplied by 1.8 multiplied by 10 naira. The answer is 18 naira. Okay, so
Right.
for the very
Thank you, Temilolua, because of time. Yes,
all
thank you.
right.
Yes, because of time. All right. Thank you very much. Raliat, can you just quickly speak? Space of 5 minutes. Yes, Raliat.
She said everything. I don't know what to say again, like the explanation. So it just
Okay.
yes.
Elizabeth.
Okay.
And
Good
since we
evening,
can,
everyone.
okay, sorry. I don't know if you want me to go further
No
or
problem.
continue
No,
from
don't
where she
worry.
stopped.
No, from my statement on the WhatsApp platform, that I expected to speak on basic variance, sales mix and yield variance, and planning and operational variance. Those are the three key points I wanted us to speak on. But since I think the message was not clear. Yes.
Oh, okay.
Yes, Elizabeth.
Okay, sorry, sir. You said we should speak on planning and operational.
Yes, you didn't read my message.
Can you hear me, sir?
Yes, I can hear you. Okay. Let me go on with my class.
Sir, can I go ahead?
Yes,
Can
go
I
ahead.
talk on? All right. Okay, so I'll quickly speak on the type of variants that we have. We have
Hello?
variance, as we know, it's already is broadly classified into two main categories, and the variance is divided into cost variance and revenue or sales variance. Under the cost variance, we have material, labor, and overhead. For material, we have material price variance and material usage variance. And then for labor, we have labor rate variance and labor efficiency variance. Under the overhead, we have variable overhead and fixed overhead. For variable overhead, we have variable overhead expenditure variance and variable efficiency variance. Then we also have variable overhead cost variance, which is usually the addition of the expenditure and the variance and the efficiency variance. Then for fixed overhead variance, we have fixed overhead variance divided into two. We have the fixed overhead variance and fixed overhead expenditure variance. Fixed overhead variance is divided into two again, which have fixed overhead efficiency variance and fixed overhead capacity variance. All of these broad classifications that are divided into smaller units have each of their formulas, which I think our lecturer or our tutor will take us through. And during the arguments on the group, I was one of the ones that stated it that if you can just cram the formulas, it is easy because the formulas really look alike. So it's just for you to know which one is under cost, material, labor, overhead, or variable or fixed overhead, and then you'll be able to intermatch the formulas. Thank you.
All right, thank you very much.
Sir, can I say just quickly?
Hello, sir.
All right, Madam
Hello.
Dolapo. Elizabeth, just give us minutes. Yes, I don't know.
Thank you, sir. I want to thank you, sir, for the privilege and kudos to the three speakers who have spoken before me. When we are talking about variance, there is something I want us to understand there. Some at times, cramming the topic, cramming the what is it called, the formula may not be of good interest to us because we may get to example, God forbid, everything may wipe out. What I want us to know about variance is the first speaker said variance is the difference between budgeted and actual. So just know that variance is the difference between budgeted and actual. Once you know that will help you, it will serve as basis for you to know all your formula. That when we are talking about sales price, you should know that the variance of sales price is the difference between the actual price and the budgeted price. That is just what I want to, that's on that aspect. Another one, when we are talking about variance, there is something that is very, very key that we need to first of all prepare. That will be the one that will guide us to other what do you call calculations, which is standard cost card. Very important. We need to know how to prepare standard cost card. And while we have done that, in sales variance, for us not to misinterpret our variance, it is advisable that actual always come first before budgeted. Maybe sales price variance, we have to say actual price because that is what is coming in. That will give you the reasonable variance. And when we are talking about cost variance, the budgeted have to come first before the actual, because that is what you budgeted for, that is what you plan for, before you now talk about what did I actually buy at the end of the day to give you reasonable variance instead of you cracking your head how the variance is going to be. Again, please, when we are talking about quantity sold and quantity produced, we have to be very careful there because examiner can hide under that, give us different quantity of production and sales. So once we have to note that once you see there is difference between quantity produced and quantity sold, it means there are inventory in the store. That's we ask us at the end of the day to prepare income statement, which has to be valued as standard cost of the material. So maybe when we talk about planning and operating variance, we talk about ex ante and ex post. Ex ante is the initial, the two of them are budgeted, budgeted activity. But the ex ante is the very first one we plan. But due to circumstances, maybe inflation and maybe something happened that we need to plan and we need to project for another thing, we now have to
Please
have
increase your
expo.
voice. We can't hear you. And you're making a good point.
No, we can hear her. I think it's from your side.
The two of them,
I
two of
can
them
hear
are
how.
projected. Two of them, the two of them
Yeah,
are
also,
projected activities, which have to be, hey, please, which have to be all hands in hand with other activity. So when we are talking about ex ante is used for planning variance. You would place ex ante with actual, and export is for operational variance. You would place it with actual. Thank you so much, sir.
All right, thank you very much for those valuable contributions to this class. It's a very good ones. I believe quite a number of
Hello,
persons
sir.
have benefited. Yes, I can.
Hello, sir. Hello, sir. Can I ask something there?
Yes, Mr. Fortune.
Discussion. Yeah, yes, yes.
Sir, can you hear me?
Good evening, class.
Just hold on, Elizabeth. Yeah.
Good evening,
Yeah.
class.
Okay.
I believe these formulas is quite easy to get. For me, it's quite easy to get because the only different thing there is your material price and your material usage. Then your labor over variable rates and efficiency with variable overhead rates and variable overhead efficiency are the same thing. The only
Mr.
different
Fortune,
thing
can you
there.
move close to your speaker? Can you move close to your
Okay.
speaker? Yes.
Okay. I'm using a headset. So okay, let me recap. Now, material price and material usage are the only variance formula that are different. Now, if you come to labor variance rates, efficiency variance rates, and variable overheads and variable overhead efficiency rates are the same thing. So now, if we say that our material is selling price minus actual times the actual quantity, then that is for the selling for the material price. Then the material usage is the selling quantity minus the actual quantity multiply the selling price. Now that is different thing. Now the ones that are together is the labor variance rates, efficiency labor variance rates, both the overhead and the efficiency. Now the labor variance rate is selling rates, my selling price minus actual rates, yes, selling rates minus actual rates times the actual hours. It is the same thing with the variable overhead rates, which is the selling rates minus the actual rates multiplied by the actual hours. Do you understand what I'm saying? Now,
Yes.
the efficiency for labor, the efficiency for labor rates is the same thing as the variable overhead efficiency rate. That's what I'm trying to get here. Let me recap again. Now, the labor variable overhead rate is the same thing, is the same formula as the overhead hour rates. Selling rates minus actual rates multiplied by the actual rates, actual hours for the labor. Now the variable overhead rates, selling rates minus the actual rates multiplied by the actual hour. For the efficiency based on the variable, you have the selling rates, selling hour minus the actual hour multiplied by the what? The selling rates. It's the same thing with what? Selling hour minus the actual hour multiplied by what? the selling rate on the variable overhead efficiency.
All right. Thank you
I
very
don't know
much.
if you can get it.
Yes, we're fine.
Okay, sorry, sir. Thank you.
Okay. All right. Thank you. Elizabeth, very fast, so that I can just Elizabeth.
Okay, good evening, everyone. I don't know if you can hear me clearly.
Very well. We can hear you clearly.
Sapu- Okay. There's just few most of the people they've spoken almost everything. But one thing, it's easy instead of cramming. I think there's some pattern we can follow. Everything that has to do with rates and price has almost similar formulas. Everything that has to do with quantity has almost similar formulas. For instance, if you talk about, they say variance is basically the difference between the standard and the actual. So when you are looking for the total variance of maybe say material, is the standard cost of material minus the actual cost of the material. And for the material, it's already splitted into two. Now you are talking about the price and the labor, and the price and the usage. The same thing applies to labor. Labor is talking about the rate and the efficiency. So if you check it, the formulas are equal, they are similar. So let's say, for instance, for the price now, you are saying the standard price now minus your actual price. Then most times for pricing, for anything that has to do with rates, anything that has to do with rate and price, it is wedged against the actual, which means standard price minus actual price, then the actual quantity you purchase. So it is wedged against it. Then if it has to do with usage, if it has to do with quantity, it is wedged against the standard. I don't know if you understand. And most times when you are doing a standard quantity, it has to be flexed. So you are calculating it on the actual production. So if you are doing your standard quantity, it's based on actual production. If you are doing your standard hour, actual production. So they are quite similar. Once you use rates, if you can remember one rate for material price, you can do it for labor rates. It's just to change standard. Now you are now changing your standard rate minus your actual rate. Then it's your actual hour worked. So it will be your actual hour. So it's the same thing. Then when you talk about, let me talk about a little bit about operations and operational variance and planning variance. For the planning variance, is something that is in the control of the management. So what are they saying? They have to do with ex ante and ex post. The ex ante is like you've budgeted to go and buy something. You want to buy a shoe. In your mind, you say, okay, this shoe is 1,000 naira. But someone else now bought that same shoe and told you, oh, the price has changed, it is 1,200. So it is still based on a budget that you've not actually bought. But maybe unfortunately, you going to the market, you found out the shoe now is now actually 1,500. So for the operational, what are you doing? You are minusing your first budget minus your second budget. So your ex ante minus your ex post. So the same way you are applying it for your material and price, you just bring almost the same pattern. So if you are using ex ante standard price minus ex post standard price, so now, but you have to now bring, since it is ex post, so it's more like you are bringing in from material price. It's now your ex ante standard price minus the ex post standard price. You now wedge it against your ex ante ex post standard quantity. But I feel I know the advanced variance can be crazy, but I think there's similarity between all the rates. Rate and price is the same thing. Quantity, that's your usage, your efficiency, even for fixed, it is all the same thing. I hope it helped a little.
Very well. Thank you very much.
Thank you, sir.
It's a good one. Yes. So very quickly, variance analysis. Variance analysis. Variance analysis. The word variance, just to build on what they've said, represents the difference between the standard cost of production and the actual cost of production, or simply the difference between the budgeted revenue and the actual revenue. So the process of classifying a given variance into its subvariance is described as variance analysis. So a given variance may be interpreted to represent adverse or favorable. Now, variance in simple time is the difference between standard and actual. Now, in every organization, there is a standard, there is a budget. And let me put it this way, that standard is used for units, budget is used for total. Take note of that. That is why most times you see standard cost card. The element of the standard cost card is displaying cost element in units. But when it is budget, it's showing you the overall cost of producing a particular product. So standard is linked to units, budget is linked to total. So what make up cost? What make up cost? What are the components of cost? Why variance analysis? Why variance analysis is for cost control. So the elements of cost are what we'll be looking at. We try to see how to control the variations, the deviations, as we operate as an organization. The standard we ought to spend on 1 kg of material is 2 naira. But the actual, the reality, we are spending 3 naira. What is the reason? Is it that the marketing unit, the procurement unit cannot bargain well? Is it that we've employed inexperienced staffs that they don't know how to bargain well? Or is there shady deals in the organization? Now, the operational manager will want to see, how can we look into this? What is the cause of this disparity? And hence, the need for variance. Now, we've said variance, in simple terms, is the difference between standard and actual. What is your standard? What is the actual? Now, why are you looking at variance? The purpose of looking at variance is cost. Cost. What make up this cost in an organization? If you look at the standard cost card, you always see, let me present one. Yes, this is a standard variable cost card. You can see this is showing cost details of a unit, of 1 unit, of 1 unit. Material, 15 square feet, 5 naira.
Okay. We can't see yours. It's not showing.
I'm showing my screen.
It's not displaying. Nothing is showing.
No, I think others can see it.
Okay. Please confirm if you can see it.
Yes. Other co-hosts, can you see it? Yes, we can see. I can see the right one. Yes. You can check your network. So this is a standard cost card. Now, what are these elements of costs? Please write. Don't wait for my slide. Reasons why some of us don't catch some of these things. You don't write. You feel relaxed in your house. Yes, so you write. Right. Let me show it. What constitutes this cost? What are the elements of cost? So I'll present it this way. It's a cost element. Cost element. The cost elements. Number 1 cost element I'll talk about is material. Material. When we talk about material, these are components. These are components from which goods are produced. From which goods are produced. These are the makeup of a product. These are the makeup of a product. The makeup of a product. Now, when you talk about material, there are two things involved in material. Two things involved in material to you as an organization. The price of the material is important. The quantity you want to get is important. Now, talking about material, we'll be looking at price variance, and also we'll look at quantity variance. Quantity variance. Quantity variance. Now, under price variance, material price variance, that is the standard you set for you to purchase materials and the actual reality in the market, the prevailing market condition. The difference between these two will give us variance. Now, in terms of material, the price variance will be what? Will be the standard. Will be standard. Standard price. I'll be writing it in full. Standard price less actual price. Less actual price. Multiply by what? The actual quantity purchase. Multiply by actual quantity purchase. So standard price less actual price multiply by actual quantity purchase. I will represent this as AQ, actual quantity purchase. So for you to determine material price variance, in a question, you must know what your standard price is. Then you must know what your actual price is. In relation, then you weight it. You multiply it by the actual quantity. For example, looking at this question now, you always see the statement will always show it what the standard is, what the budgeted is, and what the actual is. Now, in this question, looking at the standard price of material, the standard price of material is clear. This is standard variable cost card. Every information here is standard. You look out for it. The standard material price here is what? It's 5 naira. 5 naira per square foot. The actual, once you read further, you see material purchase 40,000 square feet at what price? This is the actual, because the statement clearly puts that the company records material price variance at the time of purchase. The following activity occurred during the month of April. So this is the reality. What happened? I'm not solving this question. I'm just using it as a guide. This is the reality. So the actual price of material is what? 5 naira 30 kobo per square foot. Now the actual quantity purchased is what? Take note. Students used to make mistake between material purchase and material used. They are two different things. Yes, when you're solving a question, you must always open your eyes to see and read statements clearly. Material purchase, material use, unit produced, you must know where to use them per time. So for material price variance, the formula is simply standard price less actual price multiplied by what? Actual quantity purchased. Actual quantity purchased. Take note of that. So when we start solving question and you're asked to determine material price, know that what is the standard price that have been set? What is the actual that have occurred? In relation to the actual quantity purchased, you determine your material price variance. It's not a difficult thing. Yes. Yes, as I've said, you don't need to cram the formula. Once you start solving, you get used to it. Yes, anything that involves formula, what I do, I can write it over and over again. It becomes part of me, so that once I see question, I'll know the application at every point in time. So because when you cram, exam situations can yes, you can just lose concentration sometimes. But just understand it, practicalize it, and it will just be part of you. So for material price variance, the standard price less actual price multiplied by what? Actual quantity. Now, in terms of quantity, when you talk about material in relation to quantity, you're talking about usage. Usage. When we want to look at the usage variance in terms of material, that is material usage variance. Let me write this more. Is material price variance. Now, talking about material usage variance. Material usage variance. When you talk about usage, what are you looking for? As they've mentioned, it's standard relation to actual. Standard and actual. These are the two things you are looking for. Material usage variance. This will be what? Usage has to do with quantity, unit, quantity, unit. Now, it will be what? It will be standard. Now, depending when Madame Delacroix was explaining, she said you can always make your actual to come first. Yes, depending, just know the interpretation, yes, of the formulas. That when in terms of cost, when your actual is greater than your standard, you know what? It is unfavorable, it is adverse in terms of cost. But when your actual is less than the standard, in terms of cost, it is favorable. In terms of revenue, when your actual is greater than your standard, in terms of revenue, income, when your actual is greater than your standard, it shows it is favorable. It shows it is favorable. Please, can you put your question on the chat box, please? Material usage variance. We have standard quantity less actual quantity. Now, this will be in relation to what? We'll multiply this by what? By price. Multiply this by the standard price. Multiply this by the standard price. So this will be standard price. This will be standard price. Now, there is one thing again with material usage variance. Material usage variance can be split into two. Under material usage variance, there's what we call mix variance and yield variance. Mix variance and yield variance. When we talk about mix variance, talking about components of materials used in the production of one product. When a product consists of more than one material, it means there is a mix of material in that product. So sometimes you might be required to compute the mix variance. The mix variance, we'll look at that. And the yield variance has to do with output. When you combine this material, what is the result? What is the result? So that is the yield variance. We'll come to look at that. Now, talking about material, let's look at labor. Labor. Another element of cost is labor. Labor, labor cost, the rate you pay. And what is labor? From the elementary economics, they will tell you that labor is a mental or physical effort put toward, exacted toward a production process that can be skilled or unskilled. So you can have what we call mixed labor mixed variance likewise, and you can have yield. And when you talk about labor mixed variance, it can be referred to as team variance or composition variance. Yes, that is when you have group of persons putting their skills together. What is the mix? Now, the yield is what output, what result can they give to you? That is the yield. So when you talk about labor in terms of price, what should you look out for in terms of price? You'll be paying your laborers, you pay your workers. So you look at rates. You look at rates. So in terms of labor, we can have what we call the labor rate variance. Labor rate variance. Labor rate variance. And you talk about labor rate variance, you should look out for what? Your standard rate and your actual rate. You should look out for your standard rate and your actual rate in a question. When you look out for this, you relate this to what? The actual hours paid for, the actual hours worked. So labor rate variance, the formula is what? Is standard rate less what? Actual rate. Less actual rate. Multiply by what? The actual hours. Actual hours paid for. Let me represent it this way. I encourage us to write so that some of these abbreviations, you have them in your notes. Clearly written. So labor rate variance is standard rate less actual rates multiplied by what? Actual hours paid for. Yes, because you see standard hours in the question. So you should know what to use. You should know what to use. Now, talking about labor rate variance in terms of price, in terms of quantity, how will you look at labor in terms of quantity? You look at labor in form of efficiency. In form of efficiency. How well are you using your labor hour? Are you working based on time or you are using extra time? Or do we have idle time in between work process? And this idle time might not be caused by the workers. It can be as a result of the environment where they have epileptic power supply and there is breakdown in production process at some point. Some situations where the machine breaks down, the machine is tired, and despite the workers' willingness to work, but the tools to work are not there. So there will be idle time because you have to pay the workers. You agreed, it's not their fault. So looking at labor in terms of quantity, we'll be talking about labor efficiency variance. Labor efficiency variance. Labor efficiency variance. Now, when we talk about labor efficiency variance, you're talking about what will be the quantity now you are looking at in terms of efficiency. In terms of efficiency, the quantity you should be looking at should be hours. Should be hours in terms of labor efficiency. So, what are you comparing? What two activity are you comparing? You'll be looking at your standard hour, your standard hour, your standard hour less actual hour, less actual hour. Now, you multiply this with what? You multiply this with what? With standard rates. Yes, Elizabeth made mention of some valid points while she was explaining. Now, anytime you see standard hour, anytime you see standard hour, you see standard quantity, it must be flexed. What do I mean by it must be flexed? You must multiply that standard hour by the actual production. Take note of that. Take note, please. Anytime we are using standard hour, it's not just standard hour now. It is standard hour. If you watch the video during the normal classes, I think I mentioned that. So it is standard hour of actual production, not just standard hour. In your notes, put it that way. Standard hour of actual production. It shows you flexed the standard hour to suit the actual production level. That is how to use standard hour in a question, because sometimes you just pick the figure directly without linking it with the actual production. You will not get it. You just be looking for figures in the question and or in the solution in the Pathfinder, and you'll be wondering what is happening. So also standard quantity, anywhere you have to use standard quantity, it is standard quantity of actual production. These two words, please, these two items, standard quantity, standard hour, must be linked to actual production. You must flex it. So you multiply that value by the actual production to make use of it appropriately. That is how to make use of these two items, standard quantity and standard hour. Take notes. They will not tell you, but that is the application. You flex it. So looking at labor efficiency, I said there can be situation where we have idle time. Now, please take note. Anytime you have to calculate idle time variance will always be adverse. To always be adverse. It can never be favorable, because being idle is not part of the objective. Why they employ the workers? They are employed to work based on the agreed contractual terms. So now, let's move ahead. Haven't talked about labor variance. What other cost elements do we have? Do you know? What other cost elements? Haven't talked about material, labor. What other cost elements do you know? Think about that. We have variable overhead. Variable overhead. Variable overhead. Now, when you talk about variable overhead, in terms of price, what are you looking out for? What are you looking out for? You should be looking out for standard variable rate. Standard variable rate. I'll put them in acronym now. Standard variable rate less what? Actual variable rate. This will be related to what? Standard variable rate in relation to actual variable rate will be weighted by what? Actual hours. By actual hours. So what is the standard variable rate in the question? What is the actual variable rate in the question in relation to the actual hours? That's, you will use that to determine what we call your expenditure variance. Expenditure variance. Expenditure variance. Expenditure variance. Expenditure variance. Now, looking at variable overhead. Looking at variable overhead in terms of quantity. In terms of quantity, it will be what? We'll be looking at efficiency variance again. efficiency variance, variable overhead efficiency variance. Efficiency variance. Efficiency variance. Now, how do we determine efficiency variance? How do we determine efficiency variance? It will be what? It will be standard hour. Take note, standard hours flexed. Flexed. That is in relation to actual production. Take note of that. Standard hours flexed. You can put that in your own notes as a subscript. Standard hours flexed less actual hours worked. Actual hours worked multiply by what? Multiply by the standard rates. Multiply by the standard rates. So this variable overhead variance in terms of price. You look at it in terms of expenditure. How much are you paying? In terms of quantity, how well are you using the available hours? Variable overhead variance. Then we have the fixed overhead. There is another element of cost. Fixed overhead. Fixed overhead. Now, talking about fixed overhead, in terms of price, how much are you spending? Fixed overhead, we can look at expenditure, fixed overhead expenditure, or we can see it as fixed overhead budget variance, whichever. So fixed overhead expenditure, expenditure variance. How do we measure this? How do we measure fixed overhead expenditure variance? It is measured in terms of volume. In terms of volume. So we measure this in terms of volume. And to do this, you must know your fixed overhead volume variance. Your fixed overhead volume variance. So to determine this in terms of volume, it is budgeted fixed overhead less actual fixed overhead. Budgeted fixed overhead less actual fixed overhead. Less actual fixed overhead. That is the expenditure variance. The expenditure variance for fixed overhead. For fixed overhead. So also the fixed overhead volume variance. The fixed overhead volume variance. Let me put it this way. In terms of volume, to break it down, fixed overhead, fixed overhead volume variance, fixed overhead volume variance. It will be actual production less budgeted production multiplied by what? Fixed overhead absorption rate. Fixed overhead absorption rate. I know most times students do find it difficult to determine all these. The first two, I know it's always a very simple one. Fixed production overhead variance. The fixed production overhead variance, we have the expenditure variance and we have the volume variance. Now, this volume variance can further be broken down into capacity variance and efficiency variance. Capacity variance and efficiency variance. So when we talk about the fixed overhead variance, this represents under or over absorbed fixed production overhead. Under or over absorbed fixed production overhead. So the fixed production overhead variance is the difference between the fixed production overhead absorbed and the actual fixed production overhead incurred. So under absorption is an adverse variance, while over absorption is a favorable variance. Now, one thing you must know how to determine in a question, the fixed overhead absorption rate. While we were solving a question yesterday, yes, we solved something like that. That is overhead absorption rate. When you're trying to determine fixed overhead absorption rate, it will not always be given to you. You have to determine that. Fixed overhead absorption rate. What is the formula? It is what? Budgeted fixed overhead. Budgeted fixed overhead divide by what? Budgeted level of activity. Similar to what we talked about yesterday. Budgeted level of activity. Budgeted level of activity. So the fixed production overhead absorbed, for you to determine that, once you get your fixed overhead absorption rate, either in hours or in units, you need to determine your fixed production overhead absorbed. How do you determine that? Your fixed production overhead absorbed. Fixed production overhead absorbed. It is your fixed production overhead absorption rate. If you determine it per hour, multiply by the actual output or production. So the fixed production overhead absorbed is fixed overhead absorption rate per hour multiplied by actual output or production. Now, talking about total fixed overhead variance. Total fixed overhead variance. Total fixed overhead variance. Total fixed overhead variance. How do you determine that? How do you determine that? Total fixed overhead variance. How do you determine that? It is what? Fixed production overhead absorbed less actual. I need to ask a question now. Less actual fixed production overhead. When we talk about absorbed, what do we mean? Absorbed. The co-host, anybody? Help. Absorbed. The co-hosts talk about absorbed. What are we referring to?
Listen,
Yes, I can hear you, ma'am.
okay, the cost of the costs, the amount of stores incurred.
Sorry, we can't hear you, ma'am.
I said, so the amount that cost, the amount that don't even know how to put it.
Okay.
I can tell you that it is incurred
Okay, I can get response from the chat box already. Can get response that absorbed is allocating costs. Yes, the usage that absorbed is the flexed fixed overhead, allocating indirect costs. Yes. So when we talk about absorbed, it has to do with the allocation based on the formula that fixed overhead absorption rate. You allocate by knowing your budgeted fixed overhead and you divide by the budgeted level of activity. That's result you have, you allocate. You allocate. So the fixed overhead expenditure is the difference between the budgeted fixed production overhead and the actual production overhead. Budgeted fixed overhead. The budgeted fixed overhead. It is fixed overhead absorption rate per hour multiplied by the budgeted hours. Multiplied by the budgeted hours. But in simple time, let me just present the formula that most of us are used to. So fixed production overhead volume variance. Fixed production overhead volume variance. Overhead volume variance. The formula is what? Is budgeted output budgeted output less actual output multiplied by what? Standard rate per unit. Standard rate per unit. It can be presented depending. It can be budgeted hours depending on how the question is structured. Depending on how the question is structured. The fixed production overhead volume variance can be, depending on the component in the question, budgeted hours less standard hours. Yes. Budgeted hours less actual hours. Let me make this one standard hours. So depending, multiply by the standard rate. Standard rate per hour. When you're working in total, this standard will be budgeted. Will be budgeted. When you're working in total, the standard will be budgeted. So very quickly, let me move to sales variance. Sales variance is related to the question we want to solve. Sales variance. the sales variance is otherwise known as revenue variance. Sales variance is otherwise known as revenue variance. Now, when you talk about sales variance, it can be divided into two. Sales variance can be divided into two. Sales variance can be divided into two. And what are those two breakdown? We have sales price variance. Sales price variance. Sales price variance. How do you determine your sales price variance? This has to do with price now. Two things you have to look out for is what? Your standard selling price less actual selling price. Actual selling price multiplied by what? Actual quantity sold. Actual quantity sold. This is sales price variance. So also under sales variance, you can have the sales volume variance. Sales volume variance. Sales volume variance. Now, sales volume variance can also be splitted into sales mix variance and sales quantity variance. Now, for you to determine your sales volume variance, that is the quantity sold now. Volume has to do with quantity. For you to determine your sales volume variance, it will be what? Budgeted quantity. Budgeted quantity sold less what? Actual quantity sold multiply by what? Multiply by standard profit. Yes. Those that explained the other time, one of the speakers make it clear that when the question is telling you absorption costing, absorption approach, when it is absorption, it means the end result will be standard profit. But when the question is only giving you variable cost, what you will determine in the long run will be standard contribution. When you have variable cost, it shows that is marginal costing. But when you have combination of fixed and variable, it is absorption costing. So sales volume variance, it's budgeted quantity sold less actual quantity sold, depending what will you weigh it with. If the question is tilting toward absorption costing, it will be multiplied by standard profit. Standard profit. Or take note, standard contribution. Standard contribution, where the question is flagging marginal costing to you, where the flagging is marginal costing. Instead of standard profit, it will be standard contribution. Take note of that. It will be standard contribution. And I've established that standard is a unit cost concept and budget is a total cost concept. So they are both estimates. Take note, they are both estimates. They are just estimates of values, of figures. So now, the sales volume variance, I said it's a makeup of sales mix variance and sales quantity variance. Sales mix variance indicates the effect on profit of changing the mix of actual sales from the standard mix. The sales mix variance shows the effect on profit of changing the mix of actual sales. When you change the actual sales mix from what the standard is, you have what we call sales mix variance. Sales mix variance. Sales mix variance. Sales mix variance. Now, how do we determine sales mix variance? How do we determine sales mix variance? Sales mix variance is revised budgeted quantity. Revised budgeted quantity less actual sorry, let me put my phone on and do not disturb. So the sales mix variance is revised budgeted quantity less actual quantity. Less actual quantity. Actual quantity sold. Multiply by what? Multiply by standard profits. Multiply by standard profits. Now, the question is this: what is revised budgeted quantity? Revised budgeted quantity. How do we determine that? Revised budgeted quantity. It is revised budgeted quantity. That is RBQ. It is your actual quantity multiplied by what? Standard mix. Standard mix. Actual quantity multiplied by standard mix. That is your revised budgeted quantity. We're going to see that as we begin to solve soon. So also we have the sales quantity variance. Quantity variance in this case is the yield variance. Sales quantity variance. Sales quantity variance is otherwise known as yield variance in the case of material. So how do we determine that? It's budgeted quantity minus revised budgeted quantity. Revised budgeted quantity. Sorry, this is budgeted quantity sold. Less revised budgeted quantity, still similar to the above, multiply by standard profits or contribution. Multiply by standard profits or contribution. So this is a background to the question we need to solve. Then when we solve, then I continue on the planning variance. Continue on planning variance. I'll just give the explain that and give the formulas. There is a question in the Pathfinder that we share, and we'll try and see how we can solve and share our solutions. So moving to the question now, the one I forwarded that has been briefly explained. Let's see how we can solve it. Let's see how we can solve that question. This question. Now, can somebody read again? One of the co-hosts. Let's please look at the statement very well as they read. Yes, the co-host. Can anybody read?
This and Sons Limited use absorption. Can you hear me, sir?
Okay, your network is bad, man. Let somebody else read, man.
Agege and Sons Bakery Limited uses absorption costing techniques in its accounting system. The company produces and sells three bakery products, namely four corner loaves, round corner loaves and executive loaves, which are substitute for each other. The following standard selling price and cost data relate to these three products. We have product selling price, direct material, direct labor and variable expenses. For product F, we have 200 per unit. The under direct material 25 kg at 3 naira per kg. Under direct labor per unit, we have 1.2 hours at 10 naira per hour. The under variable expenses, we have 1.2 hours at 5 naira per hour. Product R, 250 under selling price. Under direct material, we have 30 kg at 3 naira per kg. Under direct labor, we have 1.5 hours at 10 naira per hour. Under variable expenses, we have 1.5 hours at 5 naira per hour. Product E, we have 300 per unit under selling price. Direct material 38 kg at 3 naira per kg. Under direct labor 1.8 hour at 10 naira per hour. Variable expenses 1.8 hour at 5 naira per hour. Annual budgeted fixed production overhead was 4,320,000. The company policy is that overhead will be absorbed on a machine hour basis. The standard machine hour for each product and the monthly budgeted level of production and sales for each product are as follows. Products: standard machine hour per unit for F is 0.3 hour, for R is 0.6 hour, then for E is 0.8 hour. Monthly budgeted production and sales in units: 10,000 for F, 13,000 for R, then 9,000 for E. Actual volumes and selling price for the three products in a particular month are as follows. Products F, actual selling price per unit is 220, for R is 260, then for E is 320. Actual production and sales in units is 95 for F, 13,005 for R, 8,005 for E. You are required to A. Calculate the following variance for the particular month. Roman figure 1, sales price variance. Roman figure 2, sales volume variance. Roman figure 3, sales mix variance. And 4, sales quantity variance. Then B. Determine the monthly budgeted profit for the company. C. Discuss the significance of sales mix variance in a variance accounting system.
Okay, man. All right, thank you very much. It's So the question now, sales price variance. Sales price variance that calculate the following variances for the particular month. One, sales price variance. From the question, we have three products. Three products. It shows that we have to calculate sales price variance for each of the products. Now, the question is, which formula will I use? Sales price variance. From all what you've put down. From all what you've put down, look at your notes. The sales price variance is what? Sales price variance is what? Sales price variance. The formula you have to use is what for sales price variance? So solution. I will change my slide now.
Standard selling price minus actual selling price.
So solution. Agege and Sons Bakery. Your presentation too matters as you try to answer your questions. Agege and Sons Bakery Limited. First, we have to compute for the sales price. Sales price variance. Sales price variance. Sales price variance. Now, to do this, sales price variance, the formula is what? It's standard selling price. Standard selling price. Because you're comparing standard and actual. Less what? Actual selling price. Less actual selling price. Multiplied by what? Actual quantity sold. Actual quantity sold. So from the question, we have three products. We have three products. Products F, R, E. Three products F, R, E. Now, for product F, question we should ask ourselves is this: what is the standard selling price? From the question. But now I can't display the question again because I've moved away from that point.
For F is 200, for R 250, and E 300.
Okay. So for product F now, it is, the standard selling price is 200. The actual selling price is what? Check your question. Everybody, check your question. You see it. The actual selling price is what? It's 220. 220. If you are not seeing the actual selling price, then I'd see an emoji that you are not seeing it. Zena, Laura, you are not seeing it. Okay. People are not seeing it. Let's show them. So the actual selling price from the question, actual volumes, anything
500.
that is actual volumes and selling prices for the three products in a particular month are as follows. See it, please. Get the
500.
question. The question is on the WhatsApp. This is it. Actual selling price per unit. Do you see it? Actual production and sales. See it. It's clearly the answer is just looking at you, telling you, make use of me. So remove that concept that variance is difficult. Just calm yourself down and follow it. Follow the question. There is no any big deal with it. Just know what to do. Apply your formula. Whatever you can do. Good. You get your mark and go. So the actual quantity is what? Is 95. Is 95. So once you multiply standard selling price less actual selling price, you have what? The difference is what? 20. So 20, you ask yourself, is this favorable? Because the standard you set is 200, but the actual is 220. So in terms, this is revenue coming in now. This is money coming in. Is this favorable or adverse? Will this be favorable or adverse? The co-host, anybody? Would this be favorable or adverse?
Favorable, sir.
It's favorable because the actual value 220 is greater than the standard. This is money coming in, so you should be happy that more is coming in than you expected. So 20 multiplied by 95 will give you what? Here's your calculator. Should give us 190,000. Favorable. You have one mark already. Now, for R, you do same. The standard selling price is what for R? Is 250. Check the question, is there, it's given free of charge. Now, the actual selling price is what? For R, is 260. The actual quantity sold is what? From the question. Actual quantity sold, we have it as 13,500. The question you have to ask yourself again, the standard is 250, the actual is 260. In terms of revenue, more is coming in than planned. So the difference is what? It's 10. So 10 multiplied by 13.5. This is a favorable game likewise. So we have 135,000 favorable. The next product is E. Product E. The standard selling price is what? For product E, it's 300. The actual selling price is what? Check the question. It's 320. The actual quantity sold is what? Actual quantity sold is 8,500. So the difference now is what? 300 against 320. The actual is greater than the standard. This is favorable. So 20 multiplied by 85. The co-host, you can help me with the figures, please. 20 multiplied by 85.
170,000.
170 favorable. So what you do now, you add everything. 190,000 favorable, 135,000 favorable, 170,000 favorable. The sales price variance will be what? Sales price variance.
You can't see the screen again. We can't hear you, sir.
Hello, sir. We can't hear you.
Please, any co-host should take over before he joins, if possible, please.
Network has
Hello? Can you hear me, please?
Yes, ma'am.
Though my network has so I think we okay. No, it's back. Okay, maybe we'll do it with the network. I think where we have it, complete variant. Please, is that where we are?
We just finished
Please, your volume. You are using the Zoom volume.
sales price variance. Now we are supposed to proceed to sales volume variance.
The network stopped on my end before we could finish the sales price variance, so I could not finish that part.
So on sales price variance, we did from all the we're on total sales price variance, that's 190 favorable plus 135 favorable plus 170 favorable to give us a total of 495 favorable. So it means that the sales price variance is on the favorable side. It means like we are having a profit compared to what we budgeted, right? Someone should come in, please.
Hello, class. Hello, can you hear me, guys?
Yes, we can hear you.
Yes,
Yes,
we
we
can
can.
hear
We can hear you,
you.
please.
All right. So I'm actually the first lady that did the presentation. So let me just continue with the question. Let me continue with the question. Okay, so we've done sales price variance, which is the actual price minus standard price multiplied by actual quantity. So, and eventually all the answers are favorable due to the fact that the standard price is lower than the actual price. You know, we were given standard price, but the price we eventually sold the goods is higher than the standard, so it means it's favorable. So let's quickly go to the sales volume. So like I said earlier, I said to calculate our sales volume variance, we need to know our standard profits. We need to know our standard profits. And for us to know our standard profits, from the question we have the standard we have our standard price. We have our standard price, which is for F is 200, R is 250, and E is 300. So then our direct material, the direct material cost, we have 25 multiplied by 3, which is 75 for F. Then 30 multiplied by 3, 90. E, 38 multiplied by 3, which is 114, which is 114. Then for
Hello, hello. Sorry, it's like you are a little bit fast.
oh, okay, sorry. Okay, I'm just looking at the time. Sorry about that. Okay, so then the labor now, the labor under labor, if you check your question, you'll see direct labor per unit, which is 1.2 hours multiplied by the 10 naira you are looking at. That's the 10 naira per hour. So that's 12 naira, the result. Then for hour, we have 1.5 hours multiplied by 10 naira per hour, which is 15. And then for E, we have 1.8 hours multiplied by 10, which is 18, which is 18.
Sorry, we are not following. Please, you're fast. You're too fast.
I'm too fast. Okay. Sorry, I'm doing this for the first time, so I'm just sorry about that.
Then bring it out. We are
Okay,
here.
sorry, are we on number two, sales variance volume?
You can continue. You are doing good.
I'm on sales variance,
You are
sales
doing good,
volume
but you are
variance.
very fast. Not that you're a bit fast. You are
Okay.
very fast. Even someone that
Sorry,
might
Okay.
want to
can
do
you
the
start
Okay.
from the
next can't even
beginning?
get anything.
From
Okay.
volume
I will
variance,
just be calm.
please.
All right.
Thank you.
Okay. I should start from where? Sales
Can you
price.
start from no sales volume variance from the beginning, please?
Okay. All right.
Thank
All right.
you.
All right. You're welcome. So, okay, from the beginning now, sales volume variance. The formula is budgeted quantity minus actual quantity multiplied by standard profits. Standard profits. Now, the reason why we are having standard profit is because we were told in the question that the company, that's Agege and Son Bakery, they use absorption costing technique. Had it been, the question is telling us that they use marginal costing techniques, we will not be using standard profit in our calculation. We will be using standard contribution. Marginal costing goes with contribution, while absorption costing goes with standard profits. Please, let's take note of that. Okay, so now I said in the question, we already have our,
Can you come again? Sorry.
okay, sales volume variance. The formula is this: budgeted quantity less actual quantity multiplied by standard profits. The budgeted quantity is in the question. If you look at the question, we have monthly budgeted production and sales in units, which is 10,000 for F, 13,000 for R, and 9,000 for E. Those are our budgeted quantity. So they gave us from the question. Then for actual quantity as well, if you look at it, we have actual production and sales. We have 9,005 for F, 13,500 for R, and 8,500 for E. We were given. But in the question, we were not given standard profits. Standard profit is not in the question. We have to work it out ourselves. And how we can work it out is this. We have our standard selling price If you look at the question, our standard selling price for F is 200, for R is 250, and for E is 300 respectively. Now, how do we get standard profit? Standard price less costs, you get your standard profit. What make up our cost? What make up our cost is the direct material, the direct labor, variable overhead, and overhead absorption rates. That is what makes up our costs. I hope I'm not too fast. If I'm too fast, please drop me back.
Okay, please for,
You,
it
you,
says
you are
standard
you are
for us
doing
to
well.
get standard profit, standard selling price
Yes,
minus cost.
yes. You get your standard profits. And all the costs are the direct material, the labor, variable overhead, and overhead absorption. Those are the costs we have according to the question. Should I continue?
Yes, please. Continue.
Yes, you can continue.
All right, all right, all
Excuse
right.
me, excuse me, excuse me.
Okay,
Can I ask you a question?
all right, ma'am.
Okay, ma, please.
What's the
To get
overhead
a
absorption you
standard
are using? It's
profit,
not the fixed cost.
You say what?
to get
Is it not the fixed
to
cost
get a
like the overhead
standard profit,
absorption?
We have the no, to get our standard profit is what I'm explaining now.
okay, to get that standard profit, is it the standard selling price minus the total cost?
Taking it
Yeah,
one step at a time. People shall I explain.
Okay,
You
thank
get there. Ah,
Hello.
let me come again.
Drop
Let
our
me come
question
again.
inside the
I
comment
said
so that I can proceed.
Please let us be quiet. Listen to her. She has explained this thing. This is the second time she has explained this.
Let
Please,
us be keeping it
let's just
inside the
concentrate
comment
and
section
listen.
so that we can proceed.
okay, guys. Let's just try and follow what I'm saying. I'm sure we will understand it. I'm trying to break it
Can,
down now
can
to
I ask
get our
something?
standard. All right.
For instance, in direct material now, are we multiplying it
Yes.
out with 25 kg multiplied by 3 naira?
Yes. Yes. That
Okay.
will give you 75. That is your direct material for F.
Yes.
Do you understand now? If you look at the question, you will see
Sorry.
it there.
Hello?
Yeah, I can hear you. I can hear you.
Sorry, please, can I just come in a little to let me see if I can make it simpler. Sorry, please.
All
You
right, all right, all right.
continue.
All right, no
Okay.
problem.
Let's just put maybe we are determination of profits.
Okay.
Split it into the different groups F, R, and E. Okay.
Yeah,
So you put selling price. We know a selling price minus all the variable costs. So now because it's profits, now we are putting variable costs and fixed costs. So put selling price. How much was for R? Put the amount there, 200. How much was
okay.
for F?
250.
250. How much was for E? Put 300.
300.
Then now
Yeah,
let's the cost. For direct material, what do we have? We have, by the time we calculate, we have 75. Put
yeah,
75 there. When you calculate for R, what do you have? 90. Put down 90. When you
yeah,
calculate for E, what do you have? 114. Put down 114. Then we
exactly.
have direct labor. When you
Labor, yes,
calculate for direct labor now, for cost, it's just to multiply. You see, they gave you this one, they didn't, it's not complicated. They say this is per hour, this is per this. And this one
exactly.
that we are doing per, so it is easy to calculate. For direct labor, when you calculate it, you have for F, you have 12. For
Yes.
R, you have 15.
15,
For
yes.
E, you have 18.
15,
So
exactly.
for variable expenses, by the time you are calculating for variable expenses, this as I'm saying, you can just be writing it because that's how to calculate it. For variable
Yeah,
expenses, you put 6. By the time you calculate for F, you get 6. By the
7.5.
time you calculate for R, you get 7.5. By the time you calculate for E, you get 9. So
Exactly.
now, cutting the variable cost, now we are looking for the fixed overhead.
Exactly.
And
So
for
for
the
the
fixed
fixed
overhead,
I know, sorry, please. All these things you are saying, you are past and nobody's writing anything. It's not as if you're already solving the question.
okay, even like this I'm fast. I was sorry.
Yes, you are
That's what
fast.
I
You are
was saying.
just your
Okay, guys.
Oh.
Where do you want us to start from? The lady that said we are fast.
Please, Mrs. Deborah, please can you just continue with the class?
Just continue, Mrs. Deborah.
Please,
Okay.
can you mute everybody on this group and let one person continue?
I don't have the power to
No.
mute. I think if somebody can do it, I'm not. I don't have the power to mute.
Can you share your screen? You should talk it.
I
Our
can't share
our
screen.
co-host should be able to. Our co-host should be able
Please,
to do it.
Yeah.
well, sorry, my sister. I will advise you just continue with the lecture.
Let me
Like
not
after
be
20 or 10
doing
minutes, you give some people to ask questions or something. People can't be asking
All right.
questions like that. We can't move.
All right, sir. All right, sir. I can understand that we all are eager to know it, and I pray that we all know it in Jesus' name. Don't worry, we'll have it in Jesus' name. So, like, as I was saying,
Yeah, I don't know whether I don't.
hello. Okay, for the direct material, I'm starting all over again now. For the direct material, we already have our standard price. So let me start from the direct material. If you look at the question, you will see for F, we have under direct material per unit, we have 25 kg at 3 naira. So all you just need to do it 25 kg times 3 naira, you will get 75 naira. That's for F. For R is 30 kg times 3 naira, you will get 90 naira. For E, 38 naira, 38 kg multiplied by 3 naira, you will get your 114. If you have the question with you, just keep following. You will understand it. Then you now go to the labor part, direct labor per unit. For F, we have 1.2 hours at 10 naira. It simply means that just multiply 1.2 hours multiplied by 10 naira, you will get 12 naira. Multiply 1.5 hours times 10 naira per hour, you will get 15 naira. Multiply 1.8 hours times 10 naira per hour, you will get 18 naira. That's for labor. We are done with labor. Now for variable overhead is there, variable expenses per unit. We have 1.2 hours times 5 naira. The answer is 6 naira. We have 1.5 hours times 5 naira. The answer is 7.5. Then for E, we have 1.8 naira times 5 naira. The answer is 9 naira. We've gotten our variable overhead. Now let's now go to the overhead absorption. That's the fixed part. For us to do that, if you look at the question, they said the paragraph after the values of direct material, labor, and variable expenses. They said annual budgeted fixed production overhead was 4,320,000 naira. That is your budgeted fixed production overhead. So for us to calculate our overhead, are you getting my point now? For us to calculate our overhead absorption, we need that value, budgeted overhead, which is 4,320,000 naira. Then for us, if you look at the question, do you have a question?
I think Mr.
Yes,
Okay,
continue.
Yeah, that's the question.
Okay.
okay, I'm back. So sorry.
Okay. All right.
Thank you very much for
Thank you, Deborah.
standing in.
You're
Thank
welcome.
you.
Deborah, thank you so much.
Thank you,
Yes.
Deborah.
Welcome. You're
Deborah.
welcome.
Just hope I'm not the network didn't pull me out again. So I'm trying
Better
to.
Deborah.
So, but okay, we're done with this part, right? Let me just show my workings anyway. The sales volume variance. The sales volume variance. It's The formula is the budgeted quantity less actual quantity multiplied by standard profits. Now, based on the products, right? We have product F. The budgeted quantity according to the question is what? From product F is 10,000. I believe we can see that the actual quantity is what? Is 95. Now, the standard profit, yeah, there will be a working here to show a working for standard profit. Can you all hear me, please? All right, fine.
Yes,
So
sir.
we'll show a workings here for standard profit because it's not given. So we need to work for it. We need to work for standard profit. So let all right. So all right. So, sorry, I just have to switch my network to MTN now. My location, the other network is much better. I don't know why it's developed issue now. Standard profits. So for us to determine our standard profits, the question is this: do we have standard selling price? For the three products, the co-host, please, you can just respond so that I'll know I have audience. Now, the standard price. The standard price is what? For product F, it's 200.
200.
For product R, we have 250. For E, is 300. That is the standard selling price. Let's put it well. Standard selling price, 200. Now, we're trying to get profit. So we need to less the various expenses. Standard selling price less the various expenses. What are the various expenses? As seen in the question, we have direct material. Direct material. Now, for product F, what is the quantity of direct material for product F per unit? Is what? Anybody there?
250
Yeah,
kg.
it's 25 kg.
25
5 kg. What is the price per kg? 3
3
naira. Let me
naira.
just show these 4 workings. So 25 kg multiplied by 3. So the value of direct material for product F will be what? Will be 75. It's an expense, so we'll less it. Now for product R, the value of direct material will be what? For product R. Check the question, you see it.
90.
90 multiplied by what? The sales value.
30 kg. 30 kg.
So the value when you multiply, you have what?
90.
You have 90. And for E to be what? For E.
88 times 3.
So the value when you multiply, you have what? You should have
4.
115. Now, so also the other cost element is direct labor. Direct labor. Now, I will show for product F. I will show the workings for product F. For product F, how many hours do we need? Do we use? 1.2 hours is in the question. 1.2 hours multiplied by what is the rate? It's 10. So the direct labor cost will be what? 1.2 hours multiplied by 10. Then you have what? You have 12. Then for R, the value will be
It's
what?
15. 15.
And for E, the value will be what?
18. 18.
18. Now the next cost element will be what? Variable expense. Variable expense. Variable expense. Now, what will be the value for product F? Let me show for the first one.
6.
1.2 multiplied by 5.
That's
Then
6.
we have 6. We have 6. And this we have 7.
7.5.
And this
9.
we have 9. Now the next cost element will be what? Anybody to try?
Overhead.
Fixed overhead. Now, from the question, how do you determine that? We need to determine our fixed overhead absorption rate. From the question, let me share the question again so that we need to understand these parts very clearly. We need to understand these parts well. Yes, from the question, the budgeted fixed cost in terms of, this is it, annual budgeted fixed production overhead was 4,320,000. 4,320,000. Now, the company's policy is that overhead will be absorbed on a machine hour basis. Machine hour basis. The interpretation of this is that standard machine hour per unit is what? For F, 0.3 hour, 0.6 hour for R, E, 0.8 hours. Now, what will be the monthly budgeted machine hour for product F? It will be 0.2 hours multiplied by 10. R, it will be 0.6 hour multiplied by 30. For E, it will be 0.8 hour multiplied by what? By 9,000. By 9,000. Take note, once you get all these, you add. When you add, this is monthly for now, but take note, this value is annual. This value is what? Is annual. But this is what? Monthly. This is monthly. This is monthly. So once you get this monthly, you multiply by 12 to get it for annual. Then once you get that, you use that value to divide these. Then you have your fixed overhead absorption rate per machine hour. So let's show the workings. Let's show the workings to that. Let's show the workings. Let's say computation of budgeted machine hour. of budgeted machine hour. Now this is monthly. Let's note monthly.
Sorry, sir, we can't see your worksheet.
Okay, all right. So this is monthly. For product F, we have it as 10,000. Can you see it now?
Yes, sir.
Multiply by 0.3. The value will be what? 3,000. And for this, for product R, it will be what? It will be 13,000 multiplied by what? 0.6. This result will be what? Should be
7,800.
7,800. And for product E, it will be what? It will be 9,000 multiplied by what? 0.8. We have it as what?
7,200.
7,200. So the total will be what?
18,000.
The total will be 18,000. 18,000. When you multiply this by 12 to give you for the value for the year, the annual value, and that will be what?
216,000.
216,000. So now the formula for fixed overhead absorption rate is what? Is budgeted fixed cost. Budgeted fixed cost divided by what? We established that some time ago. Budgeted machine hour. So in that other part, I said activity. The activity can be machine hour, labor hour, divided by machine hour. So once you apply this, so this, the budgeted fixed cost is what? In the question, I just show it to us. It's 4,320,000. So the budgeted machine hour is what? Is 216. So the fixed overhead absorption rate per machine hour is what?
20.
Okay. So we have it as 20. It's 20 naira per machine hour. Per machine hour. Yes. So I haven't derived this now. This 20 naira per machine hour. The question now is, for product F, how many hours do we need for product F?
0.3 hours.
0.3 hours. Multiply by the rate, the fixed overhead absorption rate we just derived now. We have what? It's 20. So this will be what?
6.
This should be 6. Yes. So you do same for R. So the next is what? How many hours do we need for R? It will be what?
0.6 hours times 20.
So we have it as what? As 12. And for E, to be 0.8 multiplied by 20, we have it as what?
16.
As 16. As 16. So now, the standard profit will now be what? Standard profit for product F, it will be 200 minus 75 minus 12 minus 6 minus 6. We're going to have what? 27516. This should be 101. It should be 101. And these 250, 90, 15, 7.5, 12. When you sum it and less, it should be 125.5. And for E, 300, 114, 18, 9, 16. Okay, 12, 9, 6. This should be 143. 143. So this is the standard. Please confirm, please. This should be
Yes.
all right. Please send in your questions to the chat box. Wasil, how do Deborah? You're a co-host, right? You can talk if you want to speak. You have any question?
I don't have a question. I think let me remove my hand.
Okay. Yes, Kate, I can see your hand up. All right. So this is the standard profit. Now, this is working. We're trying to determine the standard profit in relation to sales volume variance. So the standard profit for product F is what?
Sorry, sir, that was a mistake.
Okay, it's 101. 101. So now, based on this, standard profit for F is what? 101. So now, when you do the subtraction and multiplication, the result will be what? Budgeted quantity is 10,000. Actual quantity sold is what? 95. Is this favorable or adverse? Is this favorable or adverse? It is adverse because we are selling below the budget. So when you look for the difference, 500 multiplied by 101, 101 by 500, this should be 50.
Hello, sir. Hello, sir.
Yes, ma'am.
It's 121, not 101.
It's 101. No.
It's 101. It's 101.
Okay. All right. So now, for R, it will be what? Ma, you can check your computation again and see where there are mix-ups so that you'll be on the same page with us. The budgeted quantity according to the question is 13,000. The actual quantity sold also in the question is 13,500. Now, the standard profit we just derived is 125.5. The difference is what? Is this favorable or adverse? Is this favorable or adverse?
Favorable.
It's favorable.
It's
So
favorable.
because the actual is greater than the budget. So 500 multiplied by 125.5. 125.5. Yeah, with your calculator, do it. 62,750 favorable. And for product E, we have it as budgeted quantity is what, according to the question, 9,000 less actual quantity, according to the question, is 8,500 multiplied by standard profits, which we just work for 143. So this is 143. 10. Is this favorable or adverse? This is adverse. So 10 minus 500 multiplied by 143. You have what? 3 times 5 is that's C 7 1 500. This is adverse. Yes, this is adverse. So in total, sales volume variance is what? Sales volume variance is what in total?
59 to 50. Adverse.
59 to 50 adverse. 59 to 50 adverse. So this is for the A2. The A3, the question is saying what? What is the question saying? That that is for sales volume variance. Now, sales mix variance. Sales mix variance. Go back to your formula. Sales mix variance, so that when we start solving, it won't look like a magic. Sales mix variance. What is the formula? Revised budget. Revised budgeted quantity less actual quantity sold multiplied by standard profit. So sales mix variance now for each of the products. Once you get it right, you have 1 mark. Overall, 3 marks. So the sales mix variance, use another slide for this. Sales mix variance. The formula is what? Revised budgeted quantity less actual quantity sold multiplied by standard profits. So according to the question now, our revised budgeted quantity, how are we going to determine that? Let's see, determination. Or is it given to us in the question? Co-host.
No, it isn't. You calculate it.
Revised budgeted quantity. So for us to do this now, for F, the quantity is what? The budgeted is what? 10. R, the budgeted is what? 13,000. And E, the budgeted is what? Is 9,000.
9.
So the total is what? The total is what?
32,000.
32,000 is the total. Now, this revised budgeted quantity, it is standard mix in relation to what? The actual mix. The standard mix in relation to the actual quantity. Now, what is the standard mix? That is the question. The standard mix will be what? For F, it will be, this is ratio now, 10,000 divided by what? 32. What is the actual quantity? What is the actual quantity? Please put that down. That's revised budgeted quantity is equal to standard mix multiplied by actual quantity. The standard mix is what? The proportion of each product to the total. So 10 over 32. What is the actual quantity? The actual quantity in the question, the total actual quantity for the whole product. Go to the question.
31,500.
Okay, 31,500. 31,500. Everybody see it in the question. Actual 9,500 plus 13,500 plus 8,500. So when you add all those values, you have the actual quantity. So the actual quantity is 13,100. It's 13,100. So what will be the revised quantity now for product F? The revised quantity for product F will be what?
9,844.
Okay, 9,8. 9,8 what?
44. 9.
Okay. I want us to approximate to 2 decimal places. If it's giving us a decimal.
Okay, that's 9843.75.
843.75. Let's do it to, because there are some places where I want us to check if our answers are correct. So for that reason, let's maintain this. So for this, it will be 13,000 divided by what? By 32. Multiply by what? The actual quantity is the total. So you have it as what? Okay. Sorry, this is
12,000.
31,500, please. Apologies, if I'm not mistaken. 31,500. So what will be the result, please?
12,796.88.
796.88. Then for E, it's what? 9,000. See, that is 9,000 divided by 32, multiplied by 31,500. The result is what?
8,858.
Point 3 what?
38.
38. 0.38. So this is the revised budgeted quantity. The actual quantity is given in the question, and the standard profit is known. We've solved for it. So now, to get the sales mix now, for product F, it will be what? The revised is what? 9843.75 minus the actual quantity is what? For product F is 95. Actual quantity is 95. The standard profit is what? Is 101. So the difference will now be what? Actual quantity in relation to the standard, that is the revised. The relationship is what? Is it favorable or adverse? Is it favorable or adverse? Okay. And they buy adverse. Fine. Is adverse. Yes. So the difference between the two is what? 9843.75 minus 95. The result is what? Multiplied by 101. 9843.75 minus 95. 343.75 multiplied by 101. The co-host, can you help me with the figures? 9843.75 minus 95. 343.75.
343.75.
So we have it as 34. And you multiply 718.
718.75.
Now for R, the result will be what? To be 12,796.88 minus the actual. The actual is what? 13,500 multiplied by what? The standard profit, that is 125.5. You do this, the result will be what? Is this favorable or adverse? Is this favorable or adverse?
Adverse. Let's say 2 4.
Check it. It's favorable. Underline it.
Favorable, yes. It's a 2 4 1.5 6.
Favorable. So when you have the final result will be what? Should be this should be 88 242. This is favorable. Let's make this adverse. Now FRE. The revised is what? 8859.38 minus the actual is what? Is 85. Actual is 85. Actual is 85. The standard profit is what? As computed is 143. Now the result is what? The difference between these two will give us what? Is it favorable or adverse at this point again? 8859.38 minus 85. That is 359.38. 359.38 multiplied by 143. So we have it as 51,391. This is adverse. This is adverse. So the sales mix variance overall is what? Sales mix variance is what? Sales mix variance is what? The result is what? When you say 34718 adverse, that is minus plus 88242 because it's favorable minus, or you can just add the adverse and less the favorable.
You get
So
6618.53.
okay, the final result.
Yes.
Check it again. $34,718.75 adverse plus 51,391 adverse minus 88 sales mix variance. Let me see the chart box. Yeah, the chart box is right. 132. Yes, favorable. Yes, yes, very fine. 2132 favorable. So it's favorable. We can see the favorable value is higher than the addition of these two adverse. So it is favorable.
It's 6618.53.
Okay, the approximation, the decimal. So the next thing, the question is telling us to do what? Please give me the right decimal place for this, decimal value for this.
0.25.
0.25.
Yes, 0.25. It's 0.25.
So what next? The question is telling us to do that sales
quantity profit.
Sales quantity. Yes, sales quantity variance. Now, the sales quantity variance, the formula is what? Sales quantity variance. Sales quantity variance. The formula is what? That is budgeted quantity minus revised budgeted quantity multiplied by what? Standard profit Multiply by standard profits. Now, according to the question, this should not be difficult. Everybody should be able to solve this. Product F, the budgeted quantity is what? It's given in the question is 10,000. The revised budgeted quantity is what? We've shown that, computed for that. That is 9,843 point what? 9843.75. So multiply by the standard profit 101. So this will give us what? The question is this favorable or adverse? Let's test our understanding here. Budgeted is this. Revised budgeted quantity is this. So which is this? Is this favorable? Let me see from the charts. Adverse, Imran Abala, Nwogu, adverse, Zina, adverse, Oatoni, adverse. Yes, it is adverse. We have people who are set for these exams. Everybody is set for these exams. Somebody is saying it's not me. Tell it to yourself that you are set, irrespective of what might be facing you. So sales quantity variance is 10,000. So it's adverse because the budgeted is greater than the revised budgeted quantity, because the budgeted is what we are looking at, is the standard that has been set. So the revised is in relation to the actual. So in this case, it is adverse. So now, what is the result, please? 10,000 minus 9843.75, 101, should be 15. Yes, let's help me. Let's be very fast so that we can.
15, that's correct, 0.25.
Okay, 0.25. Adverse. Let's be very fast, many people will go to work tomorrow.
Sorry, Mr. Topesa. Sorry, sir. Please.
All right. Can you speak on, please? Yes, I'm waiting.
Hello, sir.
Yes, I can hear you.
Sorry, please. I don't know if we mix something in that sales mix variance. For the R, I don't know what we calculated. I'm saying we calculated 88.
Can you confirm, please?
Okay, that's 13,000, not 13,500. That's yes, I've seen it. Thank you. I've gotten it now.
So the
It was from
R.
my ends. I was using 13,000 instead of 13,500. Thank you, sir.
Right. So the R now, the budgeted quantity is what? It's 13,000. Now the revised budgeted quantity is what? As computed is 12,796.88. 12,796.88. Now the standard profit is what? 125.5. Then the results will be what? Very fast. It should be 25,492 point what? 588. Yes, can you help me with the decimal place? This will be, let me see from the chart, 25. Okay, 491.56.
0.56.
Okay, fine. 0.56. Now, for E, the budgeted quantity is what? It's 9,000 less what the revised is what? 8859.38, if I'm not mistaken, multiplied by standard profit, which is 143, is equal to what? It should be 2109. The decimal place 2108.66. All right, 2108.66. So is this favorable or adverse? That is the question now. It is adverse. It is adverse. So can we just add up everything and get the sales quantity variance overall? Sales quantity variance. The result will be what? Should be something like 61. 61.
381.47.
61381.47. 61381.47. So is this, everything is adverse? So now, sales mix variance and sales quantity variance, when you add them, you should have your sales volume variance. Yes, you can check if you are correct, because sales volume variance is divided into what? Sales mix variance and what? And sales quantity variance. So the addition or subtraction of the result should give you your sales volume variance. So now, this is our sales quantity variance. Our sales mix variance is what? The sales mix variance is this. So can we look for the difference? This is favorable, this is adverse. So can we look for the difference and see if we are going to have the sales volume figure? The sales volume figure. The sales volume figure we saw for in part 2, A2, that is sales volume variance. So can you just confirm that if we're going to have same value except for approximation issues? Yes. Yes. Okay, it's correct. Okay, good. All right. So that is a way to confirm. So that is that for this. The question, what next are we asked to do? That we should do what? Determine the monthly budgeted profit. Monthly budgeted profit for the company. 6 marks. Determine the monthly budgeted profit of the company. So how do we do that? Anytime you hear budgeted profit, you should know the format. Revenue less your expenses. Revenue less your expenses. You get your, but the expenses are always in two parts. You have your variable and you have your fixed. When you say revenue less variable, you have contribution as a result. When you have your contribution less fixed cost or fixed overhead will give you what? Let me get a response. Contribution less overhead or fixed cost will give us what? Everybody should know that by now. Profit. Good. Profit. You see this in the exams. You will need the application of this in the exam, so get to know it very well. And a question will be there that you have to apply this concept. So let's quickly get the monthly budgeted income or how has the, let me see how the, that determine the monthly budgeted profit for the company. Okay, monthly budgeted profits of, the name of this business is what? It's Agege. Let me just put it as Agege monthly budgeted profits. Is it just Agege? There's an addition to it, right? Agege and Sons Bakery. Yes, Agege and Sons Bakery. Agege and Sons Bakery. Monthly budgeted profits. How do we do this now? So now, when you're trying to ascertain profit, you must know your sales. Sales less your expenses to give you a profit. But first, our budgeted revenue will be what? Let's work this way. Budgeted revenue. You can do it in two ways, but let me do it in this format. Budgeted revenue. How do you determine your budgeted revenue? It's budgeted quantity multiplied by what? Your standard selling price. Budgeted quantity multiplied by standard selling price for each of the products. For products F, for products R, for product what? E. Then let's have our total. Now, budgeted revenue is a function of budgeted quantity multiplied by what? Standard selling price. Standard selling price. So for F now, the budgeted quantity is what? Is 10,000, right? What is the standard selling price, please? When you multiply both, you have what? Standard selling price is 200. So 200 multiplied by 10,000. Is it 200 multiplied by 10,000? Yes. You have what? 200 multiplied by 10,000. You have 2 million. 2 million. 2 million. I don't want to write the whole, I don't want to keep writing zeros. Let's do it this way. Let's suspend these zeros up here. Suspend them in this order. But your monetary value will have to be there too. Don't mind that I'm not you have to recognize it. It's measurable. Currency is measurable. So for R, what is the value? 13,000 multiplied by 250. You have it as 3,250. For E is what? Is 9,000 multiplied by what? 300. That is budgeted quantity multiplied by standard selling price. You have what? 2,700. So overall, when you add up everything, when you add it up, you add all this, 27, that is 47 plus 3,250, that is 7,950. 7,950. The next is what? Having ascertained your revenue, you can determine your costs. That is, what are the costs now? Costs, the various cost items. We have direct material. Direct material. Direct material. Now for F, the quantity of material is what? 25 kg. multiply by 3. The cost of 1 kg is 3. 3 times 25 overall. How many units are you producing? For F, it's 10,000, the budgeted. So 25 kg, let me show it. 25 kg multiplied by what? 3 multiplied by what? 10,000. So the results will be what? Should be 750 million. 3 times 5 times that. So we have 750. 750. Now for R, can you give me the value for R following this approach? Direct material for R. Okay. Yes, for R, 1,170. Good. You see that 1,170. And for E, it will be what? For E, for E, 1026. 1026. So the total is what? For this, I've said there are two ways you can solve it. Instead of doing it multiplying by 10, there is another approach to it. But just get to know this. So the next cost item is what? Direct labor. Direct labor. Direct labor. For F, it will be what? The rate per labor per hour is what? Is 1.2 multiplied by what? By 10 multiplied by what? By 10,000. So for F, you're going to have it as what? 120. Now for R, it will be what? Following that same approach, for R, it will be 195. 195. And for E, it will be what? 162. Overall, we have it as what? 120, 195, 162, 27. We have it as 477. 477. The next is the variable expenses. Variable expenses. Variable expenses. Variable expenses. Now, for F, it will be what? The value is 1.2 multiplied by what? By 5 multiplied by what? By 10,000. So for F, you're going to have it as what? That is 5 times 1.2. That should be 60 times 10. Okay. So we have it as 60. And for R, the value will be what? For R, the value is 97,500. That is 97.5. 97.5. And for E, to be what? 81. Overall, the total will be what? 238.5. That is the variable expenses. So the difference between the budgeted revenue and this various variable cost will give us what? Give us the difference. We tag as what? As budgeted contribution. budgeted contribution. Budgeted contribution. So now, the difference between 2,000 and 750 and 120 and 60 will be what? Will be 1,070. That is the budgeted value contribution for F. And for R, it will be what? 3,250 less 1,170, 195, 97.5. Going to have what? Should have 1785. The co-host, people are sleeping. 1785 points. And 27, the people on the chat box are.
My screen is going off and off. I can't see very well again.
So 27 less 1026, 16281. You have 1431. So overall, once you add all these, you're going to have what? 4,288.5. If I'm correct. Let me see from the chat box. 1431, yes. 4288.5. Okay, good. Yes. So now, what next? We need to less our fixed overhead absorbed. Fixed overhead absorbed to get our profit. Fixed overhead absorbed. Fixed overhead absorbed. For F, it will be what? For F, let me show that. To be 0.3 multiplied by what? Check the question, you see that value, and we computed for 20. So for F, it will be what? That is 2 times 3, 6 times 10. That will be 60. And for R, we'll have it as what? For R, it will be what? $156. Yes, those on the chat box are doing great job there. 156. And for E, we have it as what? Should be 144. So when you add up everything in terms of the total, 60, 156, 144, you should have 360. So when you look for the difference now, when you look for the difference, you're going to have what? Budgeted profits. So the budgeted profits is what? For F, 1,070 minus 60, you have 1,010. For R, it will be what? 1,631.50. And this will be what? 1,287. The total.
Sir,
Ma,
I think
ma,
R should be 1,629.5.
okay. 1,629.5. What of E?
1287.
1287. Then the total overall.
3926.5.
39.
26.50.
Right. Thank you. So This is what the question wants us to do regarding the B parts there. Regarding the B parts. So the next thing is what? The next, what is the question? Let's see. The question that discuss the significance of Self-Smith variances in a variance accounting system. Self-Smith variances in a variance accounting system. The question is, what is Self-Smith variance? You must know that for you to answer the question. So what is Self-Smith variance? Let's make this interactive now. Yes. Yes. Uche, you want to respond to the question? Okay, let me give room to everybody to. Yes, Adebayo Kayode.
Okay.
Yes, Adebayo.
Yes, sir. Yes, I actually want to ask question. Sorry.
All right. So
The question B.
Yes, sir.
The question B. So what I actually, the way I solve it, what I did was I apply a formula by saying standard profit times budgeted sales. So my issue is that is very short for me. Hope it will not be too short for examiner to allocate the 6 marks.
No, it will not be too short.
Because since they have given us since we have worked out standard profits before, and
Yes.
and our budgeted sales is in the question, so all I just did for each of the product is to just multiply the standard profits by budgeted sales, and I
Okay.
sum it up. It gives me the answer.
Yes, that is a short approach to, in the exam hall you have to be very smart too. But it's not every student that can apply that approach. So we have to teach the procedure. Yes.
Okay, sir. Okay.
It's
So
a
I'm
very
safe.
Yeah, safe, sir. This variance, there are various shortcuts to it. Yes, depending on how you can play with the figures and know what to do per time. So there are various routes to solving it, depending on how vast you are in it. Some people have been doing this since university days, while some are just they just joined the system. Yes, so
All right, thank you, sir.
all the differences, yeah.
Please, I have a question.
Yes, what is the question? This is not. I want us to answer a question, but you people are turning it to a question and answer session. What is the question?
Where do you get that 10,000 naira you are using to multiply all the variable costs? The constant 10,000 naira, where does it from?
Yeah, somebody should respond to that.
That
That
is
is the budgeted sales.
monthly
That is the
budgeted
budget.
production and this unit. The 10,000, the 13,000, and 9,000.
There's no 13,000 here. Oh. It's only 10, 10, 10, 10, 10.
No. It's supposed to
Check
be
it again. It's
10,000
there.
for her, 13,000 for her, 9,000 for he. That is how
You
it
see
should
this?
be.
You see this 10,000?
only F.
Yes, I'm just showing the approach for F,
Okay,
so
now I
that you
understand
follow
because I
suit.
was looking at 10, 13, 9 on my phone, on my book.
No,
Okay.
I only show the workings for one, so that you now follow suit and solve for R and E. You get?
Yeah, I do. Thank you.
So the question question, the last question there, discuss the significance of sales mix variances in a variance accounting system. Yeah, it's very quick so that I just talk about these planning variance just in a few minutes. It's not a long one. Yes, the sales mix variance. Yes, Zina.
Okay, good evening, sir. The sales mix variance shows the difference between the actual sales and the budgeted sales that the company made. Looking at the various products that were various mix of products that were sold to achieve the targets of the company, sales targets of the company.
Okay, so what is the significance now? How does it affect the operations of the organization? As in, if you have to look at the operation of the organization, what parameters, what factors will you look at? Is it in terms of profitability? Is it in terms of their decision making that results into good profits? In what perspective will you look at the significance of sales mix variance? Yes, I'm trying to put this word so that when you
Sir,
see,
sorry. It shows an effect on the profit or contribution.
okay, all right, yes, yes, I'm just trying to make us see how to answer questions, theoretical
So that
questions.
excuse me, sir. Hello, sir. Please, can you repeat it again, please? Sorry. I'm sorry, please.
Okay, no, I'm just trying to talk about respond um to their answers that the sales mix variance. The question is asking us to discuss the significance of sales mix variance in variance accounting system. So when you're looking at the significance, what are the aspects of the organization operation you should look out for? How will it affect sales? Definitely will affect profitability. Yes, to affect profitability. And sales mix variance is what? It will show the impact on the contribution margin due to difference between actual sales mix and budgeted sales mix. So this is based on the fact that sales mix consists of various activities, That is the revised budgeted quantity and the actual quantity sold in relation to the standard profit. So you can use each of these elements in the formula to even buttress your point. Yes, just look at the various aspects. The question is, why are you even computing sales mix variance? It's for you to make decision. It's for you to come to draw a conclusion, to make an inference from your results, to draw an inference from your results. So in simple terms, sales mix variance will affect profitability, will enhance or make you to decide on informed decision, and it will, in the long run, help the performance of the organization, because when you make decisions and you have control measures in place, the control measure will enable you not to deviate from the set standard. So these are some ways in which sales mix variances will impact the variance accounting system. So that is that's quite a number of questions. Now, talking about planning and operational variance. The planning and operational variance, these occur when you want to correct the level of forecasting. Planning has to do with forecasting. Planning has to do with preparing for the future. Okay. Somebody said, who got the explanation? Can you share? When you watch the video again, you write it down. Planning and operational variance. So I'll just quickly give some of the formulas. There is a very interesting, a simple question that is in the Pathfinder. When I say it's simple, it's simple. I'm not. So the planning and operational variance are two types of variance used in advanced variance analysis, especially within the standard costing and performance evaluation framework. So the planning variance, this variance arises due to changes in the original plan or standard. That is planning variance. That is planning variance. So when you have a plan, when you have a forecast, and there's a deviation, it means what is calling you. That is planning variance. The question will not just verbatim put it planning variance. They will make a statement that it is expected that we use this, we use also quantity, but due to inflation, due to changes in the economic circumstance, the plan has changed. So what do you need to do? Planning variance are variances that are not within the control of the management. They are variances that occur based on macro. It's late already and somebody is still calling me. So the planning variance are variances not within the control of the management. While operational variance, this variance reflects how well the organization performs against the revised standard. So it isolates inefficiencies that management can control. So the operational variance are those variances controllable by the management. They are controllable by the management. So planning and operational variance can be calculated in relation to sales, materials, labor. So planning variances compare standard. It compares standard. So there is nothing like actual in planning variance. Planning variance compares standard. And what are those standards? Is ex ante, ex post. Ex ante and ex post. Ex ante and ex post. The question now is, what is ex ante? What is ex post? What is ex ante? What is ex post? Somebody want to help me? Ex ante, ex post.
Hello, sir.
Yes, ma'am.
Ex ante is the best that it sets before the occurrence that make them proceed to another standard. Ex ante is the initial standard set.
Okay. Yes. Now, your network is not allowing us to get your valid points. So
The network has fallen this night. Can you hear me now?
yes, we can hear you.
I said ex ante is the very first standard that is set before the circumstance that arises that make them to set another standard. The very initial standard is ex ante.
Yes. Yes. This is very clear. So ex ante, this refers to forecasts, expectations, or estimates made before an action or event occurs. That is ex ante. As she has said, is a standard that is set before an unforeseen circumstance that might be as a result of political, economic activity, and the organization need to look inward and see how to redress or adjust that their plan. A very good example is the event of COVID-19. It's an unexpected uh, uh, issue, but with the coming of COVID, so many adjustments have to take place. So somebody says almost midnight. Okay. So, all right, we'll go now. So, planning variance compare standard. What are the standard? Ex ante and ex post. And ex post is after the event. Ex post is after the event. Is after the event. Now, talking about operational variance now. Operational variance. These are variants that are within the control of the management. And the operational variance is comparing two things, ex post and actual. Take note, ex post and actual. While planning variance is comparing what? Ex ante and ex post. Ex ante is the first standard or target set or the initial standard, while ex post is the later standard or target that is set. Take note of that. Please write them down. I don't have them in my slide. So now you can solve for planning variance in different ways. You can solve for planning variance in relation to material price planning variance. Material price planning variance is involve formula. Let me quickly put them down now. Now you can solve for, let's say, material. Somebody said I should continue. As the network was misbehaving, I was angry because I don't want to postpone this class at all. Yes, I don't. I already set a target. I have to material price planning variance. Because if I don't do this class this night, I'll not be happy with myself. So material price planning variances. How do you do it? I need to rest for 2 days. Material price planning variances. So the formula is what? Is ex ante. Ex ante. Take note of material price planning variance. Ex ante. In the question, you see the reflection. Ex ante. I believe you've put down the meaning of ex ante. Is the first standard. Ex post is the later, after the event has occurred. So ex ante standard price minus ex post. Ex post standard price. Ex post standard price. Multiply by what? Multiply by what? Anybody with prior knowledge? It will be multiplied by ex post standard quantity. Standard quantity. You know, we talked about standard quantity and standard hour. Like it must always be on what? On actual production. It must always be flexed. So ex post standard quantity based on, let me write it in full now, based on actual production. Based on actual production. Write it down. Based on actual production. Sometimes you don't write it down. That is why some things look complex. Write it down with your writing. So when you are seeing your writing, you will smile and be happy. But when you are seeing somebody else's write up, once it is your write up, you'll be happy with yourself and you'll be willing to study it. Now, we can have material usage variance. Material usage variance. So sorry, I'm taking your time. I'm so sorry, please. Material usage variance. So how do we do this now? Material usage planning variance. We're talking about planning now. Planning variance. Material usage planning variance. The formula is what? Planning. Usage planning. What will happen here is ex ante standard quantity. Standard quantity will be flexed. Take note, standard quantity, actual hour, and standard hour, they'll always be flexed. Based on what? Based on actual production. Take note, I'm just writing it in full. Less what? Ex post standard quantity. Ex post standard quantity. The standard quantity will also be on what? Based on what? Actual production. Based on actual production. Take note, based on actual production. On actual
Sir,
production.
I thought it's only exposed that we based on actual production. Will ex ante also based on actual production?
Yes, since it's based on standard quantity. Since it involves standard quantity, this is the determinant of actual production, sir. Standard quantity, exposed standard quantity. Anything standard quantity, standard hour, sir, it will be linked with actual production. So multiply by what? Yes. Multiply by ex ante.
Standard price.
Ex ante standard price. Yeah. Ex ante standard price. What else again? On this planning variance, we can have labor. Yes. We can have labor. Labor rate planning variance. Labor rate planning variance. Labor rate planning variance. So how do you do it? In terms of rate, you should have known what rate is all about. Labor rate should be standard rate. Yes, by now you should be, this is your first time. You should be playing with those things now. Labor rates, this will be what? Ex ante. Ex ante is at standard rates minus what? Ex post. Ex post standard rates. It will be weighted by what? Somebody should help me.
Ex post standard hour.
Ex
Based
post.
on actual production.
Ex post standard hour based on actual production. Based on actual production. Based on actual production. The next will be after rates, we can have efficiency. Yes, there's labor. Labor efficiency. Labor efficiency. So you must go and sleep over this thing and know it, please. And know it. All these aspects of variance, please know them. There is one aspect. Did I talk about it? There's one aspect. Yes, I did. Is this revised? Because I know a question will come. Question will come on any of these parts. So that is why I don't just want to ignore it. You know, it's been long they tested this planning, all these S ante, and so they can decide to come in these aspects. So just everything you need to know about variance, just know it. So anywhere they come, you'll be able to attack them well. So labor efficiency planning variance. This will be X ante standard hour. You know, efficiency has to do with hour now, a capacity. Standard hour. It will now be based on what? Based on actual production. Let me represent that with AP. Less exposed less exposed standard hour based on actual production. Now it will be multiplied by what? Weighted by what?
Ex ante standard rate.
Okay. Ex ante standard rate. Ex ante standard rate. Ex ante standard rate. Let's quickly look at the operational variance. Operational variance. Have anybody solved any question on this? On the variance. There is a question on cake. Yes, there's a question in the Pathfinder. Have you solved any question on operational variance? Anybody? I think there are about 2 questions. Yes, Mr. Udu. Yes. No, sir. I will check for the question tonight. I have like 2 questions. I will forward them. 3 questions. There is one Spirit is leading me to. So I'll send 3 questions tonight. Just take your time. If you don't understand this topic, please settle down, go over it again. Yes, don't just attack question when you've not studied the topic. That is when you'll be saying the topic is hard, is this. You study first before you attempt question. So operational variance, it is in relation to S post and an actual. These are the 2 things involved here. So material price. Let's look at material price operational variance. Operational variance. Material price operational variance. So how will this happen now? It will be X post. This is price. X post standard price less actual price multiplied by what? Actual quantity. Actual quantity. Is this just actual quantity? I want to test an understanding here. Is it just actual quantity or actual quantity produced?
Excuse me, sorry. I don't know. I did operational variance.
Based on actual production. Material price operation. It will be actual quantity purchased. Sir, your network is bad, sir. We can't hear you as much. The next is material.
Okay. I was trying to ask if this operational variance expose minus actual what, sir?
No, no, sir. I'm just trying to show an expression. Let me. Material usage operational variance. Material usage operational variance. It is this usage now is in terms of quantity. So we have it as what? Exposed. Exposed standard quantity. Standard quantity based on actual production. Even in basic variance, that is how you when you see trying to use standard quantity, it will be based on actual. So minus actual
quantity used.
Actual quantity used. Yes, can define it that way. Multiply by what? X.
Exposed standard price.
Exposed standard price. Exposed standard price. So now, next, let's look at labor rate operational variance. Labor rate operational variance. Labor rate operational variance. Labor rate operational variance. Now, when you're talking about rates, you should know what is happening now. Standard rate, actual hour. So you don't need to cram. Just when you write this down like 5 times, you'll be used to it. You know, our math teachers those days, anytime we have formula, he asks us to write and rewrite. So when I adopt that approach, it will just be part of me. So labor rate operational variance is exposed standard rate, exposed standard rate less actual rate. Now, it will be weighted by what? Multiplied by what?
Actual hour.
Multiplied by actual hour. And let's see rate. Then we still have efficiency. Yes, efficiency. Labor efficiency variance. Labor efficiency variance. Labor efficiency variance. Not just efficiency now, but operational. Labor efficiency operational. Operational variance. So we have it as what? As exposed standard hour, efficiency in terms of capacity, standard hour. This will be based on what?
Based on actual production.
Actual production in relation to less actual hour. I hope those that will watch the video understand what AP is. So, and as actual hour multiplied by what?
Exposed standard rate.
Standard rates. Exposed standard rates. So, due to time factor, I will send a question that involve these 2 questions in the Pathfinder. These and other
Hello,
questions that involve.
Hello, sir.
Yes, sir.
Can we solve one question out of
Yes.
it? Can we solve one question? It's very important, sir. Or yes, you are tired.
No, that's our question now. This is 11:50. The point is this, sir. Do you have prior knowledge of this?
Not really.
Not really. Okay. I'll send the question. You read it. You read the question. Then you can reach out to me, because let me just tell you the truth. If I should begin to solve many questions, there is no time. I have my own books to read too. So, and even you still see some people coming to me physically in my location. So those writing exams. So tomorrow in my office, I'll not be free too. So what is there is that the question I will send, sir.
Okay.
Once I send it, you read it based on this understanding. Then you can message me, sir.
Okay, no problem.
Please, because my plan is to come again to meet you on Wednesday. I want to talk about NOPAT and EVA, economy value added. Though in the study pack, it's just discussed briefly, but the question in the study pack was lifted directly at one point in time. It was tested. So my plan is to come up again on Wednesday, maybe in the morning. Yes.
That morning lecture is, I think, it's very better. It makes your head will be open. It will just go in direct. That evening time is always stressful somehow, but you don't have a choice.
I don't even like this evening class. I'm not.
That morning class is very better.
Once
I have to take my leave for this, because I don't want to be any studies.
But some people, it's not convenient for them. So, but if you want it to be convenient for everybody, you will not do anything. So that is why I don't listen to some of those comments on the platform, because if you even this night now, some people will still complain. So in life, if you want to do anything, you have to create time for it. If not, you keep having excuse. Even this exam, if you keep having excuse upon excuse not to write ICANN exams, so you just have to make bold steps and decisions to travail on some issues in life. So please, I will send you questions.
Just follow the formula according to you.
Yes. So once you solve those in this class, once you solve, you just send to the platform. And if you can help me do some little write-ups on some gray areas, in the Pathfinder, what they do in the Pathfinder is they will not tell you how they derive some figures. So once you solve, just put some notes so that somebody that is looking at it for the first time will be able to have a good understanding on the process, on the solution. So once you solve, put some notes that this is it, this is that, to get this, to get that. It will make anybody looking at the solution like a footnote, add notes to it, to your workings. Yeah, so that anybody going through it will have good knowledge of what you saw, because the tutor might not actually have time as much. So many things on my I have to tackle. Yes.
That's right.
So for the EVA and yes, and no parts, I will come up on that. Then if I have time, maybe Wednesday, then Friday morning again, I will talk about cost volume profit analysis. Cost volume profit analysis. Then the transfer pricing, please try and watch that video I forwarded. It's very key. And if you have questions, you can reach out to me. Then also again, the theory part, please try and read them. Questions will definitely come. Yes, it's sure they will come. So please, I don't want anybody to rewrite it again. And aside reading, please plan yourself towards the exams. Plan yourself towards the exams. Know what to do. Yes, if this is not your first time of writing the exams, at least by now, you should have some experience where to start your answering your question from. I discover question 7. The last question is always theory, and it can Once you start well, it will boost your confidence in the exam. So when you go and start with a question that can pull someone down, it can be very alarming. Somebody is saying capital budgeting too. Yes, I've checked. Capital budgeting is most times it's not often tested, but I think I have a slide on that. Maybe I will share my slide. For the slide, I only talk about MPV and internal rate of return in relation to, because I checked the ICANN study pack. It's just,
Sorry for that. There's one question when I was going through the past question. Can you hear me, sir?
Yes, I can hear you, sir.
On throughput.
Yes, sir.
2 days ago, they said the question.
Yes, sir.
2 days ago. So when I look at the days ago, I now discover that the comment, because after solving, I read the comment of the examiner.
Yes.
I discovered that the performance was very low. So I'm suspecting that throughput they might repeat it again.
Okay, I think I know the question.
They say the student performed woefully in that particular aspect. They can repeat it again.
Yes.
Because my mind is just telling me that throughput they can repeat it again. And it's 20 mark.
Mr.
Yes.
Tope, sorry, sir. With what this man just said now, I wanted to share it with you also. That throughput accounting. The question it was tested in 2020. 2 days after the same question again. They just changed the machine capacity. I don't know if I can forward the question to you, sir.
Is it May 2020?
There's one they said 2023. If I'm not mistaken.
I think
that question because the demand they use there, I think it's about the 300,000. If you can check it, 304 and 140,000. Then says something that they use is 12,500, and if I'm not mistaken, the question they couldn't the comment. I repeat the question comment of the examiner. They say student does not how to determine throughput, that the performance was below, not even below average, that it was poor.
I don't know. Did I discuss throughput in the main class?
No, sir.
Yes, you did.
Maybe I'm not there.
Yes, because I know the question you are referring to. I think some of my students have solved it and they called my attention to it. So based on what I explained in the YouTube class, some of them attempted it. It's just a point that that is not clear. So you said May 2023, right?
Yes, 2023.
May
2023 or May 2023. Is that the two? Just check.
Okay, I think I've seen it. Collar PLC, right? Is it?
Yes.
Collar PLC sells
300,000 and 140,000.
Okay, it's not this one.
November 2023.
Let me go to November 2023. Okay, this relevant costs. Is Abuja.
I think it is November 2023, question 4, PK Limited. Is that what you are referring to?
Question 4. Okay, you can just share the question with me, sir.
Okay.
Then somebody is putting on the chat box relevant costing. Please, the video on relevant costing, the one we treated in class, is detailed enough. But please, on relevant costing and transfer pricing, if you have any reading material, read it, understand it. Understand it. The English might not be sweet the way you like it, but you just need to understand the English, the rule to solve relevant costing and transfer pricing. Once you understand the rule, any question you see, even when people are saying it's difficult, you'll be able to navigate through. But once you don't understand the literature behind those two topics, to be very difficult. Please, you can also know your ratios, please. Your ratios: return on capital employed, residual income, profit margin, current ratio, quick ratio, gearing ratio, interest cover. Yes, you can. Some of you are doing FR. You can know them likewise. They are very important. Let's just be fully set and everything will be fine. So I can see question 4. Model A, model B, machine hours are insufficient. Calculation of projected profit, throughput accounting ratio. Is it this question? Let me see the year.
Yes, I think that's the question. That
That's
was
the question,
if you
sir.
remember some days ago, what somebody was asking you that in a situation whereby we were not giving what was it called? I don't know how you structured the question, that can you divide by 1? And I responded that there is an hidden statement there in the bullet 3, of the question. So yes, that question is so broad and so tricky.
That question is somehow. And the comment of the examiner is somehow. So it's very, and they can repeat it again.
Let me see the comments of the examiner. The question tests candidate knowledge of marginal costing technique as a tool for capacity decision vis-a-vis throughput accounting. It also tests computation of throughput accounting ratio. The attempt on the question, which were in 4 parts, A to D, by candidates was very low. The candidates recorded below average performance. The pitfall notice was the inability of the candidate to comprehend the concept of throughput accounting. Candidates are encouraged to intensively use the ICANN study guide when preparing for future examination. Yes, I think this is the question.
The comment is not good.
So it's November 2023. Yes, November 2023. So you've attempted the question, sir?
Yes, I've attempted it. I got it, but you feel it's like you are cramming. It's not good. So it's hard for you to know, to flow with it.
So you cram.
It's for the betterment of everybody in the platform, so that we can all flow with it.
Okay. All right. I pray for grace and strength.
Amen.
Yes. If I have strength, I can stay here till morning. But I'm considering my own health and some other things.
Yes, very important. Very important.
Yeah, when I try to dodge my official work, so my guys will not understand. So some of those things I have to try and balance the whole thing. So that is it. No problem. Let's see how it goes now. On Wednesday, God's willing, we'll meet and we'll keep interacting. Yes. So let's have a blessed night.
Thank you very much, sir.
And you too, sir.
Have
a
blessed
blessed
day.
day.
Thank you, sir. You too, sir.